Hello traders, the title of the video is how to identify the irregular first Elliott wave precisely. So this is the first time I'm talking about the irregular first Elliott wave, and you may be wondering, George, what's that fancy name of irregular first Elliott wave? Or you may be saying, George, I have never heard about irregular Elliott wave, first Elliott wave. And you may say to me, George, I've been using Elliott wave principle for many years, and I have read all the books about the Elliott wave theory and Elliott wave principle, and I never heard a word about irregular first Elliott wave. George, you are inventing things. Well, here we are. This is the name that I give to a specific first Elliott wave that usually occur at a specific place. A phenomenon has occurred, and very often we see that first Elliott wave that I like to label irregular first Elliott wave. Why I call it irregular first Elliott wave? Because it does not adhere to our wave count guidelines. So traders that are following us, or if you go to www.24elliottwaves.com, digit 2, digit 4, Elliott waves in plural.com, you click on wave count guidelines, you will notice that I have not talked about the irregular first Elliott wave because it does not adhere to our wave count guidelines. However, that irregular first Elliott wave does occur in the financial market, and we want to know how it formed, how it developed, and what to expect. All right, my friend. Good. Can we start now? All right. With your permission, let's start talking about how to identify the irregular first Elliott wave. First Elliott wave precisely. So, very often, you see this one here, what I label the first wave here. This is irregular first Elliott wave. It usually occurs at 138.2% Fibonacci extension reverse of the prior trend. The key word here that I choose carefully is the word reverse. I touch upon this subject a little bit in a video that we will be talking about. What's the title of the video? Yes, a video that I will be posting at the 24 Stock Trader YouTube channel. Third step to mastering common price structures in a financial market. So in fact, I recommend to all Elliott wave traders to check out that series of video that I'm posting at the 24 Stock Trader YouTube channel. First step, second step, third step to mastering common price structures in a financial market. Very, very powerful. And I don't know, traders love it so much, and I will post more video about it, all right? So usually occur at 138.2% Fibonacci extension level of the prior trend. Fibonacci extension reverse of the prior trend. So if you consider this from here to here as a trending first, if you accept or agree with me, or we take it as a trend for the purpose of this illustration, that this is a trend, we assume, we call it, we name it, we label it or as a trend, we will apply what I call Fibonacci extension reverse. The traders that are following us at 24 Stock Trader know this. We apply Fibonacci retracement first to that trending first. We apply Fibonacci retracement to that trending first, not extension. But we look below the 100% level and we highlight the 138.2% level. That's what it is now. Below the starting point of the trend. That's what I call Fibonacci 138.2% Fibonacci extension reverse of the prior trend. This one. So if you don't understand it, replay that portion of the video 100 times until you understand it. So there was a trend that has started here. If you assume, all right, you accept that. And here we apply Fibonacci retracement and we look below the starting point and we highlight that 138.2% Fibonacci extension reverse of the prior trend. Because normally the extension should be above somewhere here. That's why I'm using the word reverse. Okay, you highlight it. Very often, the irregular first area wave will start from that specific point. And this is the case here. As you can see, this is the first area wave, it's the second area wave, and the third area wave, the fourth area wave. We are now in a fifth wave that has been extended, subdivided into 5 minor waves, as I've been talking about it in a video that I posted earlier. So this is the irregular first wave. So you may say, George, that's it. I know now. I can go away. I watched 1 minute of the video. That's enough. I said to you, stay with us. The irregular first area wave very often is extended, is subdivided into 5 minor waves. Very often you'll see that. It usually prolongs. If the stock, repeat, I'm choosing my word carefully, it's not always the case. But if a trend is starting from that point onward and we have a valid irregular first wave, how do we know we have a valid irregular first wave? If the second wave did not cancel it. If you have a valid irregular first wave that's starting from exactly that point, it's usually extended. Can you really agree that this has been extended? How many years it took for this first wave to be completed? From 2003 to 2008. So it has been extended quite a while. And also talking about the length of this first wave is quite good. Didn't break the ultimate resistance here, but it breaks some resistance here. It's not bad. But you can see that this does not adhere to our wave count guidelines. That's what I call it irregular first wave. Normally, as I put it to trading, is that normally we will say we want to see an inverted head and shoulder chart pattern. We want to see a double bottom chart pattern. We want to see a corrective wave, a specific corrective wave that is completed. And then your wave cycle has ended. Possibility that, okay, a new trend will begin. Now we start counting the first wave, or at least what we are looking for, that the correction has ended, the price breaks above the channel of that correction and form the first higher low, indicating to us that the market is now ready to buy, and we start labeling this move from here to here as the first wave. As you can see here, that was not the case. But sometimes you will see that. Now, does it mean that if you did count your first wave from here, you are wrong? No, you are not wrong. If you count it from here to here's the first wave, like we did here, following our guidelines. The reason why I prefer to use our guidelines is because it allows, personally talking about myself, allow me to avoid earlier wave mistakes. So even if you are there to our guidelines, you can still, okay, count this. Continue and flow with the price. Just be aware of the irregular first wave. It can be extended. There is one of the reasons why it can be extended. Did you ask that question? Why? It's because of the 78% Fibonacci retracement of the prior trend. So if the price comes here, which I talk about in that video, third step to mastering common price strategy in the financial market, I highly recommend to all area wave traders, young and old, to watch that series of videos at 24 Stock Trader YouTube channel. So we highlighted 78% Fibonacci retracement level, because if you watch that series of videos, you understand why we have to highlight that 78% Fibonacci retracement level. We highlight the zone between the 50% and the 61.8% Fibonacci retracement level of the prior trend, which is here. You see the reaction here. You see a bit of reaction here. So very often you will notice that that irregular first wave that is starting from the 138.2% Fibonacci extension reverse of the prior trend usually is extended, can be subdivided into 5 minor waves. As the price going down, the price is acknowledging those key levels. So the first reaction that you want to see, you will see a reaction near the 100% Fibonacci retracement level. Can you see 100 here? Did the price acknowledge that level? You see here it bounced a bit. It's too small. Breakable. Can you see here? And the next level that you will try to acknowledge is the level of 78% Fibonacci retracement level. And the next level you want to acknowledge is the level between the 50% and the 61.8% Fibonacci retracement level of that prior trend here. Now, as the price, that irregular first wave is underway, is acknowledging those levels, forming, okay, the sub-minor wave of that specific, okay, all right, irregular, okay, a first wave. So by paying attention to those key level, we can have a bit of idea, okay, about the minor wave of that extended irregular first wave. So those are the key level you want to watch to understand what is happening, okay, in the financial market. This is irregular first in your wave because it does not adhere to our wave count guideline, but this is something that you need to know. So don't go away, please. Please stay with us. All right, stay put. Or pause the video, drink your favorite drink, come back, relax, cheer up, and stay with us, okay? Now, what you will notice in a financial market as an Elliott wave trader, somebody who wants to master and understand what's going on so you can teach your children, your grandchildren, from generation to generation. All right. Make your life easy. Yeah, it's true. Teach it to your children. Right? Sometime, what we call the initial public offering, stock a company is listed for the first time in the financial market. Is it Digital Look? Digital Look. There's a web page called Digital Look. That's where we have the initial public offering. If my recollection is correct, Digital Look. Digital Look. Tell me in the comment section. So, during the initial public offering, this company is listed for the first time at X price. So sometime you want to understand this carefully. So people are presenting their company, they value the company. Sometimes they value the company too high, sometimes they value it too low. All right. So they value it too high, they say, all right, this company is 5 million company. But it's not. All right, it's not. But they did it on purpose because they say there is always some fool in the financial market that will buy at the highest price, and it's going on all the time. So they value it high, okay? But they know that there are smart money out there that will spot that it has been it's 22 times, okay? Their net profit, so they're not going to buy it like Mr. O'Leary on the Shark Tank. Do you watch Shark Tank videos? Watch it if you are a technical trader. I will spend hours watching those videos. Larry always uses the 5 times the net profit to value a company, but there are many ways one can value a company, all right? O'Leary funds, check it out, all right? So they put a stock on the market for $100, but the price not $100 is in fact okay, $62, the correct price, but they put it at $100. But what you will see sometime, all right? Or the example that I gave is not too good. How can we say this stock? They say it's $100, or the stock is in fact $10. That's a bit of exaggeration, but just take it that way. All right. So what you will see first, all right, the market will quickly reject that price. They'll say, no, we are not buying at that price. That's crazy. Are you out of your mind? Your valuation is crazy. So they will sell the stock. So stock come down. This is the first reaction to S point like this. But another group of market participants will say, well, now the stock, the initial offering price is $100. Look at that. This stock is now $30. No, I mean, let's say this stock is now $70. It came on the market for $100. Now it's $70. You should be out of your mind not to buy it. Okay, so another group come and push it up. As the stock is going up, it breaks above this high here. What is the next challenge? Trader that are following our Day Pro Trader YouTube channel know it. It's 138.2% Fibonacci extension above the prior high here. So stock goes up above that high. This is the opposite of here. It went below it. Okay, now I'm talking about stock is about to go down. Here, this is a stock about to go up. So we are talking about the bullish irregular first wave. Here we are about to talk about the bearish irregular first wave. Are you with me? So another group pushes up. So stock goes up to the 138.2% Fibonacci extension level. All right. Of that first trending first. This is it. This one. Reverse. Call this 25. It's 138.2% Fibonacci extension level of the reverse of the prior trend. So we apply Fibonacci retracement in fact to this 25, and we look below the starting point of that downtrend, initial bearish move down, and we highlight the 138.2% Fibonacci extension reverse of the prior trend. Here it is. So our irregular first area wave can also start from here. Our irregular bearish first wave is likely to start here. As the price start going back down, it's going down. Okay, which level should you highlight? You will highlight the 78.6% Fibonacci retracement or this move down, the zone between the 50% 61.8% level, and also the 100% level here where that bearish first reaction has started. So you will see sometime in the financial market, a stock during the initial public offering, stock will come in the market, boom, and then you wonder what's going on. So we go down a bit, and then goes up a bit, hit that level, and then just going down. You say, what? I bought this stock $100, now it's at $10. What has happened? Now because the irregular now as the price starts here, then area we try to see what has happened. So you may see probably if everything looks good, all right, if the stock is truly bearish, if it has been overvalued big time, if the market environment is truly bearish, if a new bearish trend is starting here, so this will form the irregular first area wave, irregular bearish first wave here, and you have your second area wave, and that irregular bearish first wave is likely to be subdivided into 5 nano wave, or is likely to be extended. Not always, very often, may be extended from that point onward. 138.2% Fibonacci extension reverse of that prior bearish move up or down. And then before we see coming down, and then you will form 1, 2, 3, 4, 5 before you will start bouncing up from that point onward when the fifth wave is completed. The opposite is also true. Stock coming into the market, all right. People buy first time, but here what is happening, I'm not saying that is the case here, all right, I'm not saying that is the case here, is that sometime during the initial public offering, the stock may come into the market, okay, so they value the company a little bit higher, so they will say $2 million, that's the value of the company, but maybe it's not 2 million, all right. Is 1,600,000. All right. So a lot of people do not see it. All right. So they start buying. My stock went up for few months, even a few years. See here, from 1999 to 2000, 2 years. All right. So there it is. Went up. Okay. 2 years. Everybody buy. Everybody's happy. They say, good. Told you to buy always at the initial public offering price. Didn't I told you that, huh? No, I'm talking now, okay? So everybody's happy. And then for one reason, this mama say, well, in fact, what's going on here? This one did not come on top of our radar. Now, all the stock screening or for those highly sophisticated hedge funds spotted this stock that what's going on. Overbought, 22 times. Net profit, 100 times net profit. Oh, what's going on? Fundamentally overbought. So those high influence, okay, market participants start selling. But the reason why they're selling is to correct the price because the initial public offering was wrong. Some people bought it, they make some money, good. Now the market want to correct it, bring it to the correct price. And that correct price, as they are seeking to bring the price to the correct price, which is below the initial public offering price at the cycle point here, very often the smart money will bring it to that 138.2% Fibonacci extension reverse of this move up here. And from there onward, as the correction is in place, they correct it now. They know that, okay, a little bit below its normal price, oversold, after being over both. The correction now in place, they correct it. Now, the smart money will buy, and a trend will begin. Be careful. Be careful, my friend. I am not saying that, especially if you are a new trader, that any stock that turn around at that specific Fibonacci extension level, reverse, will definitely form a trend. I'm not saying that. If they are not making money, their product is not good, they have a useless management in play, there's no future, they're not getting more market share, the sector, there's no money flowing into that sector, we will not have any bullish trend. The stock may consolidate. So what I usually see, the price will start bouncing now, hit the 100% level from this level, hit the 100% level, and we see a consolidation below the 100% level. And the price will start there for many years until the fundamentals start improving. Sometimes some stock will not form a fully fledged trend, as this is the case here, but will go up above the 100% level. This is the 100% level. But as it hits the 78% level, 78.6% Fibonacci retracement level or the prior trend, it may pull back to retest the 100% level and then stuck below that 78.6% level for many years until the condition are fundamentally viable again. All right. Or some stock may go up above the 78% level into the zone between the 50% and 61.8% Fibonacci retracement level, and then find a resistance there and stack between the 78.6% level and the zone between the 50 and the 61.8% level for many, many years, forming a gigantic consolidation. Or we may have what we call, in the language of Elliott wave, complex corrections. Now, without too much blah 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 from my side, the irregular first Elliott wave usually occur at 138.2% Fibonacci extension, reverse of the prior trend, up or down. Usually the market is trying to correct the price after initial public offering. Sometime you will notice that we have a fully fledged bullish trend in place. It's not from the initial public offering. So as the price coming down, we are watching the zone between the 50%, 61.8% level, the sweet spot zone, expecting a new trend from there. If that does not happen, we look for the oversold zone at 78.6% level. If we didn't have a new trend from there, the price may come to the 100% level. But surprise, surprise, some stock will be below that 100% level. And the next key level that I'm watching is 138.2% Fibonacci extension, reverse of the prior trend. And very often, not always, we may have a new trend beginning from that point. It does not mean that anytime the price hit that point, we will definitely have a trend. A consolidation may follow suit, or a complex correction may develop over many years before a fully fledged trend is in place. This is true for a downtrend and also for an uptrend. Stock that are bearish, goes down fast and then bounce up to the 138.2% above the origin of the initial bearish trend, and then from there onward we have the first irregular bearish trend followed by a second, a fourth, and so on and so on and so on. So this is something you need to know if you're in the financial market. All right, let me know if you have already, you're aware of it. All right. So as I explained to you, the reason why I call it irregular is because it does not adhere to our 6 guideline that we give traders at 24 Elliott Wave YouTube channel. But you want to understand how that irregular first Elliott Wave develop. Usually it's extended. It comes from the 138.2% Fibonacci extension, reverse of the prior trend. But doesn't mean that all the time when we see a move from there, definitely there will be a trend or not, all right? So look at it. If you have any question or suggestion, put in the comment section, and in due course, I will be recording another video to answer your specific question. So you may say, George, okay, is it better to use our guideline? I will say to you, yes, definitely our guideline. If you apply our guideline here, you will be counting from here to here as the first wave. Nothing wrong with that, but just be aware. The bottom line, so in fact, what you need to do, we say to trade it all the time, is that whenever you count your wave or you are trying to label something fast wave, try to go also into the mind of other traders and ask yourself how other traders may see it. So by doing so, you have a bit of idea, okay, how other traders may see it, and you will avoid, okay, stepping on the feet of other traders or annoying people for no reason in the financial market, saying sorry, 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 sorry. All right, all right. So this will conclude our discussion today about how to identify the irregular first Elliott wave precisely. If you find this video truly useful, let us know by giving us the thumbs up. You think that George, yes, it's another blah blah blah. Mark it down. That will put us under pressure to improve our next recording. I think this is an essential tutorial. Please, 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 my friend, share it with your friend on Google Plus, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the STW24 traders talking about okay, how to identify the irregular first Elliott wave precisely. Thank you for watching, and speak to you soon.